Hey guys, this is Mr. Oxy coming at you live from Palm Beach in Florida. It is December the 14th. It is Tuesday evening. It's approximately 8 p.m. And I thought I'd do a quick follow-up on the previous video that I made, which was more related to Evergrande and a little bit sort of about the macro situation as we see it today in China. I don't have a dog in this fight. So for me, from a personal point of view, it's not that I'm indifferent, because we must always pay attention to the macro. But I didn't think particularly Evergrande was going to be as destructive, an event as what the media might have tried to portray. But at the same time, I didn't want to ignore it. And that's kind of what prompted the video, in addition to the fact that Girzor said that would be a great idea to make that video. So what I thought to do is to make a follow-up to that video and talk a little bit about how the bulls, which includes myself, are currently getting smacked down by the bears in terms of the market crashing. I do want to touch back on a couple of comments and pointers that I shared as it relates to the previous video in terms of the US and China as the sort of superpower and wannabe superpower, if I could put it that way, in terms of where we are right now. We can talk a little bit about energy, and of course, as Mr. Oxy, it would be completely expected of me to also just make a quick mention of Occidental and where it's at. But let's get into the meat on the bone here and sort of take a quick look. So just to set the stage, just very briefly, I know it's painstaking to see your stocks crashing. I am long on many of the stocks that I shared with you before, including many energy stocks. I have huge positions in some of these energy stocks, and my stocks have been tumbling and going down along with yours. But just for perspective, that little red square over there shows you the actual decline that we've currently been sort of experiencing and going through. And especially, again, just from the point of view of giving some perspective to the situation that we're in, look at where we came from just a short while ago. So if we go back sort of, to the beginning of this year, or otherwise the previous 12 months or so, look at where we are compared to with where we came from. And then that kind of gives you a little bit of a better perspective on that dip, or the couple of dips that we're experiencing right now. A quick headline here: stocks are near the lows of the day as the Dow Jones Industrial Index drops 0.5%. This was earlier today, so I'm not sure where it ended up because I actually haven't had a look. So I'm just being honest. Participation in itself is broad, with declining issues outpacing advancing issues, 2,308 to 1,020. Decliners 2,300, advancers only 1,000. During the last 5 trading days, the Dow Jones Industrial Index has lost 0.7, almost 1%, is currently trading at 35,471. It is up a lot from where we came from just a year ago, never mind 2 years ago, at the height of the pandemic in March of 2020. The majority of sectors are trading lower, along with the S&P 500, which is down 1.26% this afternoon. That was today. Again, I don't know where it ended because I didn't look. Trading higher by 0.22% today, as a 0.25% positive. Consumer staples continues its recent positive momentum. There's a surprise, right? Now, as most of you who've been following the channel will know by now, most of my equity positions are in financials and energy, and those two are about 50-50 for me, and I've kind of explained it before as being about 40-40 in terms of my total portfolio. So about 40% of it is financials, the other 40% of it is energy, and the remaining 20% are a combination of equities, which include industrial conglomerates and REITs and property and stuff like that. Talking about property, I've just sold a commercial property, so now I have a cash position again, which is cash awaiting investment. Anytime you have cash in the bank, you must always view it as cash awaiting investment. Otherwise, it will just decline along with the rest of the market. Let's revisit these two super smart dudes for a minute. And for the sake of those who don't like it, I won't say anything about the deep state. In fact, I won't even mention that at all. But let's take a look at how these economies are doing. This is from The Economist. You know what? A picture tells a great story. So if you look at the United States and China, 20 years ago compared to today, countries which share greater trade with the United States in 2000 was most of the world, being blue in terms of this little graphic over here. And I won't call this red, I'll just call it pinkish. Countries which share greater trade with China in 2020 is almost the entire world, excluding a little swath of Europe and most of North America. So my, how things change, right? A percentage of the global total, you can see the United States has been on a decline, and China has been increasing its share of this particular market quite significantly. However, I don't want you to lose sight of the fact that if we look at the wrong information in the correct manner, you might get a completely skewed picture of what's going on. The best example I can give of that particular situation right now is over the past year when they used the wrong test, the PCR test, to test people for COVID, and effectively ending up with many hundreds of thousands, if not millions of false positives using a incorrect test. So if you use incorrect data, you can arrive at a correct conclusion, but your data as a foundation was incorrect to begin with. So let me explain that in a little bit more detail. Firstly, if we say, if we could only turn back time, look at the changes here, right? So you can, maybe depending on how you read this graph, it's a little bit difficult to follow. But if you actually look at the top 100 companies by market cap, look what happens here. The United States is increasing quite dramatically. And remember, it's only this year and maybe last year that we saw a few companies actually hit the $1 trillion mark in terms of market cap. So in terms of the United States, the actual companies, and I understand and appreciate that this is sort of a situation where most of the market cap is held by just a handful of companies. I appreciate that. In other words, there are companies that have grown to $1 trillion market cap or otherwise very large just in general, but there are only a few of them. You know, it's Microsoft and Apple and Google and Tesla now, sort of Johnny come lately. But look at the light blue line over here, how Europe has sort of been declining that percentage or portion of the top 100 companies by market cap. And look how China, once again, has been growing. But if you put this into perspective, look at the actual numbers of the US companies by market cap as it has been growing. It's near 60%. So everything I just said on the previous slide is not necessarily correct. And one of the primary examples of that, in addition to the bad testing that I used as an example like PCR, is the fact that China is eating everyone's lunch when it comes to manufacturing, but the United States is eating everyone's lunch when it comes to technology. Most of the new technology advances, and most of the IT inventions are coming out of the United States. So in a way, you could say IT has pretty much replaced anything that was lost from a manufacturing point of view. And I don't mean that disrespectfully to anyone who is in manufacturing. We, my companies and I, also manufacture products, so I know what it feels like to be manufacturing. But what has happened to Europe? So Europe, in terms of its percentage of the world total, has been on a steady decline, not only in terms of GDP, but also in terms of market cap. This data, by the way, is from The Economist. It's up to date. It's fairly new. It's quite recent. So what's going to happen post-pandemic? What is the macro looking like? Well, it's going to be dramatically different from what you might have expected just 2 decades ago. 2 decades might be a long time, depending on how old you are. But for guys like me, that's just the other day. In fact, 2 decades ago, they were still warning us about a pending ice age before the world was rapidly going to be flooded because of sea level rise and global warming, which then became climate change. Tech firms make up a quarter of the global stock market, and the geographic mix has become strikingly lopsided. America and increasingly China are ascendant. Well, I just showed you that on the previous graph, accounting for 76 of the world's 100 most valuable companies. 76% of the top 100 companies are either located in the United States or China. That is a significant shift, less so for America and more so significantly for China. Who gave up the market share? Well, Europe, which used to pack a punch. The share of the elite group has fallen from 41 out of 100, so 41%, in 2000, just 20 years ago, to only 15 today. In 2000, Europe's slice of the corporate wealth was commensurate with its roughly 1/3 of the world economy. That is no longer true. So when we look at the sort of battle between the United States and China, maybe the loser in the battle between the United States and China has been the European Union. And that's not my opinion. That's what the data is showing us. Right here at the bottom of the screen, big firms invest in innovation, which boosts economic growth. Left to regulate only foreign groups, Europe's ability to shape global business norms is weak. They're not inventing, they're not creating, not manufacturing. They are in a state of steady decline. The Atlantic Council, if you want to take a look at this, you can look it up on DuckDuckGo, because that is significantly better than Google, because they don't censor information. The 2021 economic scorecard, how China stacks up with the United States and its allies. So let's take a look at these graphs. I've got two for you. The first one I'm going to do is a comparison between China, and let's ignore the open economy average, because averages are sometimes a little bit skewed, and we look at the United States. So the United States compared to China, when you talk about financial system development, market competition, modern innovation system, trade openness, etc., you can see that China is lagging the United States significantly based on the China Pathfinder scorecard of the Atlantic. But how about this? Instead of comparing the United States to China, let's compare China to China. China 2010, China today. So 20 years ago, 10 years ago, 5 years ago, obviously these things change as time goes along. You can see that China has made phenomenal strides in terms of financial system development compared or considering where they came from. Not so much on market competition, they sort of stuck there and they back where they were, very close, but on innovation, they have also done some very, very good work in terms of improving their position. And trade openness, well, that might come as a surprise to you. And of course, it depends on how these statistics are measured. But China Pathfinder from the Atlantic shows that China is much more open to trade than what they were before. Now, of course, that's also true to a large extent because many Chinese companies are publicly traded, including on exchanges in other countries, which requires them to be a little bit more open in terms of their disclosures and also to comply with disclosure requirements as it varies from market to market. And direct investment openness, well, they're lagging a little bit as well. And we know for a fact that the China Communist Party is influencing lenders and financial institutions and banks in terms of how they lend and how they treat different entities that might be looking for funding for different projects, not only in China, but also worldwide. The Atlantic Council continues and says China is conflicted. It is slowly opening its economy in some areas while swiftly retrenching in others. In key sectors, Chinese leaders are backtracking in others. They simply cannot figure out how to successfully reform. I don't have an opinion on this. I'm just sharing the news with you. And while this zigzag worked in the 2010s, it could be a self-inflicted wound or become a self-inflicted wound in the 2020s. This is a matter of fact. The growth of China over the last decade was largely built on credit-fueled spending that the country cannot afford to replicate in the decade ahead. Beijing will need to get serious about reforms that they've been promising since their ascension to the World Trade Organization 20 years ago. And to make matters worse, China's economy is on shaky ground. Now, the previous video that I made, specifically talking about things like Evergrande as an example of that, we talked a little bit about ghost cities. Some of the people responded to me on the channel. We were commenting and chatting, and they said they've actually seen some of these ghost cities firsthand. I have not. I've only seen it on YouTube. So anytime you guys can educate me on stuff like that, I appreciate it. So I appreciate the comments. And as I've said before, I read every single one of them. Sometimes I miss one, like from Joe Huerta, but I'm going to come back to that one in just a minute. China may face a severe economic slowdown. Well, that would be bad news, not only for China, but for the rest of the world as well. Well, it would be amiss if I didn't talk about Occidental at all, but let's look at the energy macro. So Jefferies Bank today, so this is time and date stamped, December 14th, 9:52 a.m. Eastern Time. Jefferies said integrated oil companies generated the highest free cash flow in over a decade, and free cash flow is expected to remain close to this level in 2022. We know this, guys. I mean, like, you've been following Oxy and you've been following Mr. Oxy. We know this. These guys are printing money. Don't be fooled by the fact that WTI, so West Texas Intermediate or Brent, is trading at 70 or thereabouts. We know because of the work that the management teams have done that their break-even points and their operational costs have been cut to nothing. So when you have a situation where your break-even, like Occidental, is quoting Vicky Hollop, sort of in the high 30s, and WTI is trading at about $70 a barrel, and that's where you make most of your revenue, you are sitting pretty and you are making a lot of money. And Jeffrey says your free cash flow is expected to remain close to the level of 2021 in 2022. Might even be better. We'll have to see how we do on a supply and demand curve basis. We see scope for further increases of dividends and buybacks at Q4 2021 results and throughout 2022. Q4 results will be really, really interesting. Don't forget, we are literally 2.5 months into the third quarter. There's 2 weeks to go, guys, unless the price of WTI drops to like, $30, $40 a barrel. Occidental, as an example, and that's just one of them, there are many of them, is printing money at that current price. There is risk. Normally, normalized leverage levels increase the risk that companies might turn to large-scale acquisitions. This is not a Occidental-specific comment from Jefferies. In fact, it is specific to one company that they use as an example, which is BP. But I'm not going to get into that one. I don't really want to discuss it on this video, and I don't want to keep you guys too long. But some of the companies might turn to large-scale acquisitions. Why? To accelerate their low-carbon transition and secure pipelines to meet long-term targets. We'll have to see what happens with that one. And keep an eye out for BP, because even though I'm giving you the highlights reel here, Jeffrey specifically managed BP when they reference this particular point that I just shared with you now. On December the 14th at 9:43 Eastern Time, just before the previous line above, Jeffries also said the current tightness in the oil market is transitory. There's that word again, right? First, the Fed used the word transitory when they talked about inflation, which is ridiculous. It's not transitory. It is etched into everything that they've done because it's just been a comedy of errors that keeps repeating and repeating and repeating. The current bunch of people that we have that's running monetary policy and fiscal policy have proven themselves to be hopelessly inept. And that is my opinion. And I'm going to stick to that until they prove me wrong. And I would love it if they prove me wrong. The Brent forecast from Jefferies Bank, $68 a barrel. High risk around this price level includes things like OPEC not being able to raise production in line with targets, the outcome of the Iran nuclear deal negotiations, potential pent-up demand hitting the market in 2022. We do know that the demand is still by far outstripping current supply. What has Occidental done to us lately, right? So first it was like looking reasonably good. It had a great third quarter. It got all the way up to almost $35 a share before it pulled back all the way to 29. Ironically, guys, Occidental has not done too badly. It's actually held reasonably steady in the face of massive declines by some of the energies, including some of Mr. Oxy's holdings. The best example I can give you of that is Energy Transfer. I mean, Energy Transfer went all the way from, my cost base is about $7 something. I went all the way to $11, right? You can do the math yourself in terms of return, just to pull back all the way to $8. I'm long and strong on Energy Transfer. I'm not too worried about it because my initial position and the subsequent add in Energy Transfer was more for the purposes of parking the money and scooping that nice big fat dividend of over 6%. At the time I made the trade, I'll sit on Energy Transfer for a while. It's not a problem. In fact, I've been thinking of potentially adding to my position, but I'm a little bit risk averse there because on the insiders, there have been more sales than what there have been buys. And I don't really like that, despite the fact that the chief operating officer has just, he just bought about $205,000 or $215,000 worth of Energy Transfer shares at a cost basis average of about $7.50 or something like that. How about the stock returns? Over the past 3 months, plus 11%. Over 6 months, only 3%. And over 12 months, 52%. Guys, if you've been riding the Oxy wave with me on your surfboard for the last year and a half or so, you're sitting pretty. You shouldn't be too worried about this. So Joe Hurt not only sent me a note and asked me about Oxy's entering into a second amended and restated credit agreement, but he also asked me to explain it. So what did I do? I did the same thing any other logical, rational, normal, which excludes me, person would do. And that is, instead of answering the question, I thought, why don't I ask Oxy's investor relations exactly what that question is? So Joe said, hey, Mr. Oxy, where did you go? Well, guys, I have actually been quite busy. One of my businesses manufactures products, and we have to manufacture products during the holiday season and make sure that we can keep up with demand. In terms of supply, we make a variety of different leather goods and other products and things like that. And in addition to that, just quite recently, my family and I opened up a charitable gift store. And of course, it's Christmas time, you know, so I've actually been working in the retail store literally every day. It's been super cool because I get lots of people to speak to. You will not believe how many Canadians there are in Florida right now. It seems like they all wanted to escape the maybe authoritarian environment that they came from, or otherwise they just wanted to escape the freezing cold winter up in Canada, while Canada is burning natural gas to heat homes. Anyway, Joe said, Occidental Petroleum slid 4.6% after the energy major signed a revised credit agreement on Friday with a syndicate of banks extending its term through the end of 2025 and cutting its borrowing capacity by 20% to $4 billion. So I said, hey, guys, investor relations, instead of me giving you the Mr. Oxy opinion on this and telling you what's going on, why don't you tell me, give me the spin, right? And the guys at investor relations were kind enough to respond quite promptly. And they said, here's a couple of key takeaways from the 8K that they filed. Oxy's credit facility was extended on a senior unsecured basis with investment grade covenants. This was very important to us, given our goal of returning to investment grade. Well, Joe, that's not the kind of news that should cause a stock to slide 4.6%. But to be fair, Oxy slid 4.6%. Not so much based on this announcement, but because the entire energy market was actually in a bit of a downturn, as it still is today. We incorporated an ESG, environmental social governance, KPI, key performance indicator, making this a sustainability-linked loan. Well, there's some big words in there that should keep some people happy and give the Green Lobby something to cheer about. And we opted to reduce the facility to $4 billion from $5 billion, given our progress and integration on debt reduction. This is good news, good news, good news. We want to achieve investment grade status. They've added a sustainability element, ESG KPI, environmental, social governance, key performance indicator. And we opted to reduce the facility. Now, guys, in the United States, if you have a facility available to you of, let's say, $5 billion, I don't, but if you do, and you actually reduce that, it negatively impacts your credit score because you've reduced the amount of credit available to you. The best way to explain that is quite simply like this. Let's say you have 2 credit cards and they both have a credit limit of $25,000. That means you have credit worthiness of $50,000 and maybe you owe nothing, which means you have credit available to you of $50,000. If you take one of the cards and you cut them up and you cancel that card, now you only have 1 credit card with a balance of $25,000, which means you have just cut your credit worthiness from a credit score point of view in half. So that's a wrap, guys. You know, like this is obviously a load of information. We talked a little bit about China and we talked about the US, and I'm imploring you there not to look at the wrong metrics in terms of comparing the 2 countries because they are very, very radically different. So what you have is a growing economy in China still today on manufacturing, even though much of the manufacturing has moved away and moved to neighboring countries or countries in close proximity, Indonesia, Malaysia, Bangladesh, etc. And then, of course, you have the United States, which is becoming the absolute dominant technology giant worldwide in terms of how we know it today. If you like my content, please subscribe. And of course, I look forward to your comments because I would like to get the conversation going and make sure that we are all at least equally intelligent or smart or otherwise the opposite of that in terms of the decisions that we make. And I'm going to be back soon with more. So I haven't gone away. I've just been busy. But thanks for watching and I'll see you guys soon. Talk to you. Bye.